Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, which I now write for and do interviews for. And I'm a finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey.com and shareholder activist.
And we are the Money Café. Well, Stephen, today's news is... Oh, look, before we go any further, I just need to apologise to Weebit Nano, because last week I misspoke and I was thinking of something else. I was thinking of another company, which I won't name, but I was thinking of something else, and I said that the word dodgy came out of my mouth in relation to Weebit Nano, and that is not the case. They are not in any way, and I said for some reason that they are competing or trying to compete with NVIDIA, which they're not. They are not doing AI chips. Their product is ReRAM, which is, they hope, going to replace flash memory. And I've interviewed Kobe Hannock a couple of times. He lives in Tel Aviv, and I'll be interviewing him again in the next couple of weeks.
Very good.
Today's news is CBA. Did you see their profit?
I did.
2%.
Up 2%
on last year, and the share price since the same time last year is up 40%.
Makes no sense, does it?
40%
no sense.
Increase in share price on a 2% increase in profit. That means the PE ratio, that is to say the price earnings ratio, which is the key valuation method for companies, has gone from about 18 times to 26 times. And it is the most expensive bank in the world.
And I did think it was interesting that their net interest margin rose by 2 basis points to 208 basis points. So that generated them $11.93 billion of gross interest margin. So
two basis points, $11 billion.
Well, no. The overall net interest margin revenue. So they're everything they paid out, and they're gloating about, we've paid $11 billion on deposits was one of their headline figures on the first page. So there's a lot of spin in the document. But I was amazed that, so they've increased their home loan book from $577 billion to $590 billion. So they've lent Australians $590 billion for housing. And I just can't believe they're still managing to increase their gross margin. I would have, with their share price soaring to record highs. Where are the politicians smashing the Commonwealth Bank for making outrageous profits and profit margins in the middle of a housing and a cost of living crisis? I mean, how they manage the politics of this while Woolies and Coles are getting beaten up is incredible.
Yeah, it is incredible. It's true. It is true. That I don't think the share price can't possibly keep going. But then again, they've said today that they're going to have another burst of profit after interest rates come down, because their margins will widen again and they'll make more money. So the share price will probably go up today. Yeah.
I mean, they're certainly making a good margin out of me. When I have loose cash sitting in my CDIA account, ready for share trading, they pay me 1.5%, and when I plunge into their margin loan, they charge me 9.65%. So, they just... Where is the political movement for Australian bank customers? There's no ginger group that's out there saying that they're overdoing it. And, but look, the dividend is up 10 cents to a record.
Sounds like a job for Supermain.
Well,
that is you.
Well,
I'm talking about.
I mean,
come on, you can be a ginger man.
Well, I mean, they've got 825,000 shareholders, but even in their data today, they talked about having 13 million shareholders because they included every single superannuation account in Australia. So they're trying to say, I mean, they are the number one brand. They claim to have the most valuable brand. They have 13 million
shareholders, don't they?
Yeah, so at least the wealth is being shared around. But it's the old story. You'd much rather be a Commonwealth Bank shareholder than a customer. The balance is all in the way of the shareholders. And, up go the profits yet again.
Speaking of Commonwealth Bank and lending, did you see my housing piece on the 7:30
I watched
show?
All 22 minutes of it the other night, Alan. I did think it was probably the best piece of television you've ever produced. It was basically a little mini version of your quarterly essay on 7:30 on housing, but I thought it was brilliantly packaged. And I was going to ask you, how did you get all those portraits of all the prime ministers in the background as you described their various policies on housing?
Well, one of the producers, Emily Jane Smith, got the portraits got them all blown up. She got them online, what you do. I don't know where and she got them all blown up. Then she went to Officeworks and got them printed large. And then she went to the props department of the ABC and got them framed. And then we trooped out to Elizabeth Farm, which is in Rose Hill near Parramatta, on the Parramatta River. And it was John MacArthur's first house. And she set up the pictures in this old room at Elizabeth Farm. And that's where I did the opening pieces to camera, which is amazing. And I had a good look around Elizabeth Farm. What a place that is. Jesus. The first building was built in 1793, which is 5 years after 1788.
Yep. So the MacArthurs, they were ultimate pioneers.
John MacArthur, and named it after his wife Elizabeth, but boy, oh boy. And I sat there on the front veranda overlooking the Parramatta River, thinking, what must it have been like back in 1793 when they started building? It could have been paradise. And John MacArthur has decided that this is his land, right? They've shown up here. He's just arrived, and they've gone, okay, there's no one here. This is ours.
It's mine. Sounds like Trump and Gaza.
And there's all these, people wandering around who happen to have black skin, who they said, they don't exist. Oh, unbelievable. Anyway,
so I thought it was a great piece. I see you're still getting stuck into John Howard and Peter Costello over the capital gains tax discount. That's the big bogey policy.
Well, it's interesting because Tim Reardon of the Property Council got stuck into me. He even was moved to put out a press release yesterday saying that I've got it wrong because it wasn't the capital gains tax discount, it was the GST. Because the GST went on new houses and didn't go on existing houses, and that was the big factor. Like
everything,
maybe.
There are many factors.
There are many factors.
And both of those two are relevant factors. I agree with you. I think that was a big one, the tax-preferred nature of it. But I was really glad you got into the supply issues with the councils. And I think there's maybe a bit of a piece about CFMEU and inability to import workers to work on housing. I think that's part. I mean, you see the biggest apartment development in Melbourne called Beulah, Twin Towers, 1.7 billion. They went broke yesterday. So that was going to be...
Did they?
Twin Towers, and they've appointed administrators. And they paid $101 million for the land. They were going to do these two...
Where's the land?
Where BMW is in South Bank.
Oh, that.
So just right near the ABC, yeah.
That was going to be the biggest building.
Twin Towers, 1.7 billion, and they've gone into administration yesterday. And so that, it's... And they said that construction costs have doubled since we bought the land.
So that project's off now?
Well, it's gone into administration. So someone might buy the permit... but, years and years and years of lobbying and permits and negotiation, and they've sold a whole 600 apartments now.
Oh, have they? And people have paid deposits.
It's gone broke.
And they're now creditors. Oh, dear, oh, dear.
Yeah, so,
that's bad.
Yeah. So I think construction costs are a big part of that. But I think everyone agrees we're not delivering the number of houses that we need. So it's going to keep getting bad as long as that happens. So now I guess we should cover off on Trump and tariffs. Every day there's something crazy, Elon Musk versus Sam Altman, and it's just, I don't know, where do you start?
Where do you start? So he's decided to impose 25% tariffs on all imports of steel and aluminium. That's the big thing. I mean, there's 10% tariffs on China have been introduced, and now it's 25% tariffs on steel and aluminium.
And aluminium is a big one for us. Like, I thought Albo yesterday's, it is our largest manufactured export. It's a rare example. Like, we're the biggest producers of bauxite. So, like with many minerals from uranium to iron ore, we've got the largest bauxite deposits in the world, and we are the biggest producer of bauxite. We then also have 5 alumina refineries to refine that bauxite, and then we have 4 aluminium smelters, and we're the largest exporter of aluminium in the world and the 6th biggest producer. So it is actually, everyone says, why doesn't Australia value add? Well, aluminium is the one sector where we do it, from, the Portland smelter to Bell Bay to Newcastle. And it'll hurt us. And it's one rare bit of manufacturing that we do. So I'm glad that Albo's going hard against that.
Sure. Well, yeah. But I mean, Trump's going to put a tax on it of 25%, going to raise the price of the aluminium into America to American consumers by 25%. So why is it going to hurt us? Is it because Americans will buy less aluminium?
Well, presumably America cranks up their own aluminium production, and we're priced out from exporting to American car manufacturers and to Boeing and the likes. So, but most of our aluminium smelters are foreign owned. It's all Rio and Alcoa and all this sort of stuff. But do you think we'll get the exemption as a country with a 2-to-1 deficit in favour of America?
Well, we certainly should.
Certainly should.
Certainly should get the exemption, but who knows? When you referred to Trump and Sam Altman of OpenAI, that's simply because Trump is leading a takeover offer for OpenAI.
Well, no, Musk is.
Sorry,
Musk
is. I keep getting the two mixed up.
Yeah.
Musk is leading a takeover offer, $97.4 billion for OpenAI. It's interesting, OpenAI is the company that launched ChatGPT, which is kind of trying to become the Google of AI. And this week they launched something called ChatGPT Deep Research, right? So I thought I'd test it out, and I gave ChatGPT Deep Research a question yesterday morning. Provide me with a deep research report on stock market reaction to tariffs throughout history. And it was great. He gave me the thing gave me these 10 dot points of, we're going to do this, I'll do this and this, and find out all these things. So it won't be long, hang tight. So I thought, okay. 2 hours later, I typed into ChatGPT Deep Research, so how's it going? I said. And he came back and says, it won't be long, I'm still working on it. And it was quite conversational. It's quite amusing, really, in a way. And it told me it won't be long. I'll come back to you with a very, very excellent report very soon. I got up this morning, it still wasn't there.
Oh,
so I don't know how long it's supposed to take, this thing.
Yeah, so, it is curious. A $93 billion offer for a not-for-profit. We've never seen that before.
But it's going to be turned into a for-profit.
Yeah, and the valuation,
fairly quick, smart.
The valuation is in the sort of the $340 billion US range is where they're looking. But they've still got to execute this switch. And Musk is obviously trying to destabilise that. And any board has to look at an offer. Apparently it hasn't been formally tabled. But it's just, I don't know how Musk keeps all these balls in the air. He's shutting down all these government agencies. He's meant to be the CEO of Tesla. And I noticed that Tesla shares fell 6% overnight and is almost back below $1 trillion market cap, having doubled in the 6 weeks since Trump got elected.
Why did it fall 6% last night?
I think just China, tariffs, just general. The thing literally, it soared. In the 6 weeks after Trump got elected, it literally soared to a peak from 243 to 480. So it literally doubled in 6 weeks. And that's how everyone came up with all those, Musk invests $250 million in campaign finance and he's got a return on his investment. But it's back to 327 now after the 7% drop overnight. So there's currently 7 companies worth more than $1 trillion, and Tesla's just hanging on at just over $1 trillion after last night's 7% fall. But, is he actually the CEO of Tesla at the moment, or is he, Rocket Man and Doge Man?
There's no way he's running Tesla day to day. How can he possibly be doing it?
I think James,
as you say, he's running the American government, basically.
And James Murdoch, as an independent Tesla director, where is he? Why isn't he reining him in and telling him to, work from home's over, mate. Get back in the office and start running Tesla. We're paying you a squillion. I don't know. It can't last, but it is unbelievable. Just every day, chaos.
Well, speaking of trillions, we've got 1 trillion questions today, so we better get into them.
Yes.
Before we do that, here's a quick word from our sponsor.
Want to learn about investing overseas? Join Nathan Bell and Nick Cummings, portfolio managers of the Intelligent Investor Select Value Share Fund, for an exclusive webinar to learn about the role of international companies in your portfolio. You'll also hear about their stock selection process, the investment case for 3 key stocks, and how the team manages currency risk in the current climate. There will also be a live Q&A. Register now to join the live session on Thursday the 20th of February at 10 a.m. or sign up to receive the recording later. Visit offer.intelligentinvestor.com.au/IISV.
So Diane says, here is a taste of Stephen's own medicine with a probing question for those like the ones that he lobs at public company AGMs. Stephen often rails against unprofitable ASX small caps. And I mean, basically, Diane goes on to say that stop complaining about the losses of small caps in the tech and the pharmaceutical sector because 1 in 10 of them turn into stars. And so this is just capitalism at work. And look, there is Pro Medicus at 30 billion. There is Telix Pharmaceuticals, market cap 9.6 billion. But I guess, Diane, what annoys me is that on August the 30th last year, 190 different companies all reported their profits and they already had accumulated losses of more than 20 million. So it's okay to lose money and we all accept that, but don't do things like try and hide the fact that you have burnt up a truckload of cash. That's the only point I'm making.
Well, what would you do? You wouldn't release your stuff on the last day, right?
Well, I just think just be open and honest and come out in a timely profit report. And, if you're Syntara, which is a Sydney-based drug development company, which has blown up 419 million and has a market cap now of 5.7 million. So they've blown up $400 million and they're sneaking out their latest loss on the last day. And I simply say, come on.
Okay. Matthew says, discussion on banks not passing rate cuts on in order to restore profit margins. Aren't banks' operating expenses less than the past and as such margins are higher? The value of the average mortgage has also increased due to property prices. As such, there is larger cash flow. It's not like the profit margins of banks has dropped, has it? No.
Well, as we saw with CBA, up profit margin up 2 basis points to 2.08.
So, but did you discern from their result this morning, which I haven't looked at, whether how much of that is due to lower costs?
Oh, I didn't get into that detail, but
because that's what Matthew's point is. A lot of it's due to lower costs.
Yeah, but the net interest margin is not a cost question because the costs are separate to that. The net interest margin is the simple case of what they're paying lenders versus depositors. So,
that's right.
And, look, our big 4 banks were last night capitalised collectively at 605 billion. Commonwealth Bank, 261 billion, more than double any other bank. I just find it amazing. And I heard James Thompson the other day saying that he reckons that when the rate cuts come, the banks are going to try and get away with not passing on the full amount. I mean, good luck with that going into an election.
Well, I think they'll pass on the fully pass on the first rate cut, but possibly not the second.
Yeah.
Just a stab in the dark.
Yeah. Now, Jen says, I'm a female artist living in the beautiful Blue Mountains west of Sydney. I post my work on my Instagram, and every few months I get a random person wanting to buy using NFTs, non-fungible tokens. I think that is. Please explain how this would work.
Don't touch them, Jen.
Yeah, look, I think NFTs are just
non-fungible tokens is what that stands for.
Yes. And they're a scam, aren't they, pretty much? Well, they're a bit like crypto. They're just not real money.
They're a digital representation of something in the real world, as I understand it. Look, there are others who know more about this than I do.
Yeah.
But
the art world is full of billionaires laundering some of their interesting profits. Lots of Russian oligarchs buy up lots of art. So, but I would simply say to anyone who's interested, some real cold, hard Australian cash transferred to my account. Nothing funny money, crypto, NFT.
Yeah, that's right. Don't take NFTs, Jen. Just take cash.
Correct.
Karen says, I have a query about whether there is any analysis on investing for retirement from the perspective of super versus property investment. I'm mid-50s female, currently sacrificing into my super fund up to the max level of 30k annually. I'm very happy with the performance, but wondering if I could be maximising my hard-earned by investing in property. Are you aware of any publication that has compared the two? Would one be more advantageous than other over 10 years? The reason for investing in property, Karen, I think largely is to do with the fact you can borrow more against it. So therefore you're more highly leveraged. You can borrow 80% of the value generally. So that means, and you can't do that with super. So
leverage is a big factor. Also, they're both very tax preferred. So I think tax is a massive driver. And the other biggest thing is liquidity. Is young people, I certainly did negatively geared property rather than overloading on super as a young person because you need it for for living. So if you lock everything up until you're 60, when you're in your 20s and 30s, and you can't borrow against it, it really is forced saving.
So Karen's mid-50s, so she's. I suppose she's 10 years off or something, retirement.
Yeah. And it's also your appetite for dealing with agents and tradies and tenants and that whole, are you up for the risk and the annoyance of actively managing a lumpy property investment.
The other point I made about property investing in my column for the ABC on Monday is that the property is a market that never crashes. Even during the recessions of 1982 and 1991, the property values, the national median house price value, only fell by 6.2% on each occasion. And the most that the property market has fallen in living memory, and since I've been alive, is 10.2% between 2017 and 2019. And so the stock market is occasionally crashes.
Always correcting, which is 10%. And you're saying the only technical correction in property, Australian residential property, has only been one in the last 50 years.
And it's interesting that occurred not because of rising interest rates, but because of the APRA crackdown on property investment, telling the banks not to lend so much to property investors. And that resulted in the biggest fall in property prices in history. So what does that tell you about what's going on in the property market?
And that was quickly reversed. And now we're back at record highs again.
The other thing to say about Karen, just while we're talking about property, is that what everyone's trying to achieve is zero capital growth in real estate. We have unaffordable housing now, and the aim of policy is to achieve zero capital growth, or it should be at least. Now, will that occur? Probably not, but maybe the policy will work. And they'll achieve zero capital growth, in which case you're better off in shares, if that's what happens.
Yep. Now, we've had a couple of questions on Visan, which is that water company. So one from Chi Yen and another one.
And I called Chi Yen Jenny.
So we're going to correct
bad.
that. So apologies.
So apologies, Chi Yen.
And
I was thinking of.
But it was a good example.
Look, it was a bad week. I had a bad week.
No. Well, But it was a good example of a question to the Money Café leading to an intelligent investor CEO interview.
Yes.
And
I interviewed James Clement, the CEO of Visan, and he was a former Collingwood footballer.
He played 230 games. He was twice an All-Australian. He was a legendary, tough Collingwood defender.
Could play the game.
And he carved you up, Alan. He took no bullshit from you. He was telling you off for not letting him finish his story, and it was very combative.
I think that was in the back.
Well,
because a freak, should have been a free kick to me.
James Clement famously, he outpointed your hero James Hird at the MCG in 2006, and because of that, they introduced the hands in the back rule. Literally because James Hird, your hero, had a sook about James Clement outpointing him with a magnificent defensive display, and I reckon there was a bit of hands in the back with your interview with James Clement. He was ticking you off for not letting you finish his story, but it is a fascinating story, isn't it?
It's a good
their
story.
Water business, I reckon it looks pretty good.
Yeah, well, I reckon good footballers often do make decent business people, and he certainly was putting that case that being a footballer taught him how to be a good business person. So yeah,
he certainly was very impressive. He's right across it. The only warning sign I would have is it's a bit like Pro Medicus says, we never deal with government hospitals. There's just too much bureaucracy. We only deal with private hospitals. So their business is dealing with government utilities in water, because water is such a government-dominated sector.
Well, we should probably explain what they do. So they took over this company which didn't have any. They had $7 million in the bank, and they didn't know what to do with themselves. So they bought they bought 16 drilling rigs that were set up for drilling for water, and they didn't have any water contracts, but they bought the rigs and then set about putting them to work, drilling for bore water, and the customers in that case mining companies, because mining companies need to have water at their mines, and so they set the rigs going in lots of mines in Western Australia, and now they've spread to the eastern states, and they're dealing with sewerage in the eastern states, and they're trying to get title over, or not ownership of, but certainly use of, a underground lake in the Pilbara or in Western Australia. So they would then, and apparently water is like a mineral deposit in the ground.
Owned by the Crown.
Water is owned by the Crown, but you can peg it and you can basically get the right to extract it. And so they're trying to get, so whereas previously that they didn't do that, they just drilled for water that other people own, now they're going to own the water, or at least have the rights to the water. So look, it's an interesting business.
Yeah, and look, there's very few listed water companies. You can go to Duxton Water, Rubicon Water, but because it's basically dominated by governments more than any other sector. But look, I encourage people to subscribe to Intelligent Investor. You can listen to all these cracking Alan Kohler CEO interviews and listen to the famous defender carving up Alan. I thought it was a cracking listen. Now, Sean says, with the rise of ETFs, what is the future of fund managers like Wilson Asset Management, NAOS, Perpetual and the like? If investors don't need stockbrokers or face-to-face advice anymore, I can't see how all these brokers and these stock pickers are going to survive. And basically he's asking, are thousands of jobs going to go with ETFs taking over everything, Alan?
I think the answer is yes, probably. I mean, ETFs are taking over everything, and also, soon we're going to get AI doing everything else that you need. So
yeah, but don't forget that we also have the death of public markets all over the world, the lack of floats, the growth of private credit. So the asset managers that are booming now are the ones that are in private equity private markets. Right. So the likes of Pinnacle, which has a market cap of 5.8 billion, and even GQG, which is listed on our market at 6.7 billion, they have been absolutely booming in recent years. What
do they invest in?
Well, GQG is just more global equities out of Florida, but Pinnacle backs all these small boutique fund managers. They're in private credit, they're in private equity, they're in all sorts of interesting stuff. So the traditional, I can pick which ASX 200 stock will do better and I can spot a good small cap, that whole market is probably going to struggle. But the fund managers that succeed are going to be those that are in the private space and value added with good returns.
Ashley says, Alan discussed last week that the unemployment rate is not rising, and this is a potential reason against rate cuts. To what degree is this a demographic issue? Loads of baby boomers retiring and the younger generation having to fill the gaps. Unemployment payments are switching from the dole to age pensions. Is there a risk the RBA is misunderstanding the situation, should be cutting harder as the economy is actually a lot more sluggish than the employment numbers suggest? There is something in that. Certainly the feeling is that the Reserve Bank's view that the natural rate of unemployment is 4.5% is now out of date. So that they're not targeting 4.5% unemployment anymore, and that the natural rate of unemployment, which is a Milton Friedman phrase, which refers to the rate of unemployment that does not cause inflation to go up, probably is, a lot of people are saying is 4%. We haven't heard from the Reserve Bank on that. But if that's the case, that's what the unemployment rate is now. And so it's probably right that the economy is more sluggish than the unemployment rate suggests. That's true. I think the factor that Ashley is mentioning is not the main thing. The main thing is that the definition of unemployment is that you worked an hour per week, and what's going on is that people are desperate to hang on to their jobs, and they're not going on the dole, they're just cutting back on hours.
They're taking second jobs as well. Because
there's a lot of second jobs.
Because people are forced to work because the balance sheets are under the pump.
That's right.
Because people have got record levels of debt. And thank God they can find work. So if you need to find work, you can find work. Which is very contrary to the whole AI doom and gloom thing, is that AI is going to wipe out everyone's jobs.
Yeah.
Now, we did have an AI question about the job losses I was going to ask you, where you were saying that you thought coding jobs were going to be one of the
jobs?
Computer coding jobs were going to be one of the big areas. And we had a question asking, saying, I'm just completing a coding degree, have I made the wrong call? So, look,
I hope not.
I listened to Mark Zuckerberg's 3 hours interview with Joe Rogan yesterday. He,
How was that?
Well, it was painful, and I didn't realise he was into, jiu-jitsu and hunting. He's really painting himself as a macho man. He's got the UFC guy on the Meta board now, and interviews with Joe Rogan. But his stock's up 17 days in a row, Alan. Meta shares are up 17 days in a row to 1.7 trillion. So he's doing the best of anyone. And he made the point that with
he seems to have curly hair now.
Yeah, look, it's weird, but
go on. He made the point. What I interrupted.
He made the point that with every technological boom in the past, there's been more jobs, not less. So he was trying to douse that fear.
Well, I reckon there's a first time for everything, and but it is true that the factories are all full of robots now, but we've got 4% unemployment. So
And as he said, 100 years ago, the majority of people worked on farms, and now there's only 2% on farms, and we're all doing other stuff. So chill. AI is not going to kill you. Was the message from the Zuck on 3 hours with Joe Rogan.
Okay, what else?
Now Dusty says. Actually, no, let's go with FD. The AFR reported that there are murmurings of Transurban being a potential takeover target, but the price is huge. And then he goes on to say, is it time for Albo to implement my ridiculous idea to borrow big and nationalise Transurban, driving down cost of living pressures and guaranteeing a big Labor victory in the next election? Well, look, it's not going to happen, FD, but I do think it would be a winner, and I do think it's crazy that we have this the world's biggest toll road company distorting urban planning decisions in our 3 biggest cities. But
it cost me $10 to get to the. It cost me $10 to get to the airport on the road.
Yeah, look.
I mean, I don't know. Then so $10 back, $10 there. It cost me $5 to get to the ABC.
Yeah.
I mean, I don't know.
We're all spending a fortune on tolls.
Yeah.
I'm thousands a year. So
and you go onto the CityLink or whatever, and it's so full of cars. It's incredible.
Yeah. So what you would do is you would nationalise it. You'd share the equity with the 3 state governments. You wouldn't abolish the tolls, but you would reduce the tolls by 30 or 40%, because if you abolished all the tolls, the roads would be total car parks. And you would just say that these assets should be with the government.
But if you reduced it by 20 or 30%, they'd be car parks.
Yeah,
wouldn't they?
That's right. But I guess I'm just saying...
I reckon nationalise them and then put up the tolls.
Well, we really need user pay pricing on all roads.
That's right.
So that's what we need, not just bizarre single toll roads here and there, and then everything else is free. I mean, it just makes no sense.
I was driving on the ring road the other day, which is free, and it's a big road. It's put a toll on the ring road. Anyway.
Dusty says, my question is about a listed investment company, which I don't own, but have been fascinated in for about a decade, called Katana Capital, ASX code KAT. Every day, and I mean literally every day, for years, they have been doing share buybacks. Is a share buyback a good way, or is this company just being privatised for the benefit of some of the big shareholders? Now, look, I had a look at Katana. They were floated in December 2005. They raised $50 million at $1 a pop. They're now down to 37 million, and they are just one of dozens and dozens of silly, tiny, listed investment companies. The chairman for the last 22 years is Dalton Gooding, who's a former West Coast Eagles president. He's now 71. Dalton, it's probably time...
That's not very old.
Well, I know it's younger than you, Alan, but I'm simply saying that what is the point of Katana Capital? I own 10 shares. All they do is invest in a few other shares. And it hasn't got scale. It's worth $37.5 million. They do a buyback to prop up their share price. If they keep buying back all the time, they'll eventually have bought back everything. And it's a pointless listed company, and there should be mass mergers and consolidation in the LIC space, because if you've got only 37 million market cap, you're too small to matter. One more, you can choose it, Alan.
Oh.
We had 30 questions this week. So
30 questions.
It's a record.
We're just swamped with questions, which is great. Thank you, everybody. Chris says, tariffs seem to be the topic of the month. As you mentioned, they can drive up prices and fuel inflation, but they may also slow economic growth. On the one hand, higher inflation could lead the RBA to raise interest rates, as controlling inflation is its primary focus. On the other hand, slower growth typically calls for lower interest rates to stimulate investment. As a market-savvy investor, could you help me better understand this dynamic? Would this situation qualify as stagflation? Okay, so I think you need to just put tariffs in the same basket as the GST.
Or a sales tax. It's just a new sales tax.
Tariffs are a sales tax or a GST on imports. And as with the GST that was imposed in Australia in 2000, the RBA doesn't pay any attention to it. It looks through it because it's once off. So tariffs might produce a one-off lift in inflation, but the central banks won't really pay any attention to that. But yes, it might slow growth. That is true, because trade encourages growth, and if there's less trade and less imports and prices go up in America, that's likely to slow the economy.
And you had an interesting graph on the news last night, Alan, showing how the growth of trade relative to the growth of the economy is falling, and this is the sort of the anti-globalization trend where more countries are going to do more things in-house to be self-dependent.
So between 1990 and the GFC, 2008, was the great era of globalisation, and trade consistently grew more than world GDP grew by. And then between the GFC and the pandemic, they basically grew at roughly the same. And now we're in for a period of trade growing at less than GDP, but it will tend to drag down GDP, I think. I mean, I think that the fact that there's less trade is not great. And partly because it'll tend to lead to less productivity, lower productivity, because productivity in the US is going to be less than in China.
And the big three things that have undermined globalisation, I reckon you'd say, would be the GFC, COVID and Trump. Because Trump has always been massively
anti-globalisation.
Anti-trade deficits, getting ripped off by the Japanese, ripped off by the Chinese.
He thinks that a trade deficit is equivalent to losing money.
Yeah.
It's losing money. Well, no, it's not. It's just buying stuff.
Yeah.
A trade deficit is buying stuff, buying more stuff than you're selling. Well,
But he is going to stick with it. I mean, the CEO of Ford overnight has said it's causing chaos. So he is determined to
What chaos did he say it's causing?
Well, it's chaos in the auto industry, because are they copying a 25% tariff from Mexico next month or not? And why aren't the South Koreans and the Japanese cars going to be tariffed? Because they're going to be all coming into America with no tariffs, and all their Ford cars coming in from Mexico are going to be tariffed. So they're saying, this is ridiculous, it's not fair. So it's a slippery slope. Once you start putting tariffs on one product, then why not other countries and other products, and away you go. Here in Australia, we are the most anti-tariff, pro-free markets, free trade country in the world. And I reckon we won't put any tariffs on in response to Trump or anyone else.
Not. No.
We love free trade.
We'll go, please, Mr. Trump, don't do it to us. Thanks for listening, everyone, to today's episode of the Money Café. I'll be back next week with James Thompson. Send in your questions to the Money Café at eurekareport.com.au. Until then, I'm Alan Kohler. I'm founder of Eureka Report, finance presenter and columnist for the ABC.
And I'm Stephen Mayne, and we'll see you in a fortnight.